What if the biggest risk isn't losing money all at once, but not noticing when it's slowly being drained? Most of us have paid for something we barely used, a subscription, a membership, something that seemed small at the time. $10 here, $20 there. It didn't hurt, it didn't feel reckless, it felt harmless. Month to month, nothing felt wrong. But years later, when you finally added it up, the number surprised you, not because any single payment was painful, but because time did the damage quietly. There was no moment where alarms went off, no sharp mistake, just money leaving, slowly enough that your brain never reacted. That's how most financial damage actually happens, not in dramatic crashes, not in obvious failures, but in long stretches where nothing looks wrong until you finally stop and look back. Stocks work the same way. Most people think risk looks like chaos, big drops, wild swings, panic headlines, so they try to avoid that. They buy what feels safe, familiar companies, big names, businesses everyone agrees are solid. And often those stocks don't crash, they don't collapse, they don't scare you, they just sit there. Sometimes they go up a little, sometimes they go nowhere. And because nothing bad happens, people assume everything is fine. But here's the part most people miss. You can lose money without ever seeing a loss. If you pay too much at the start, time becomes the risk. Not volatility, not headlines, time. When a stock is already expensive, it has very little room to help you. Even if the company does well, the price may already reflect that success, so years pass. Your money is tied up, inflation keeps moving, opportunities pass by, and the quiet cost isn't a crash, it's what your money didn't do while it was sitting there. This is why safe stocks can be misleading. They feel safe because they don't surprise you, they don't demand emotional effort, you're not checking the price every day, you're not worried about bad news, but safety isn't about how calm something feels. It's about whether the outcome matches the time you give it. A stock doesn't need to fall to hurt you. It just needs to underperform quietly while years go by. That's a harder loss to notice because nothing breaks, no red screens, no panic stories, just time doing its work in the background. This happens because we focus on the wrong thing. We focus on movement. We watch for drops. We fear sudden losses, but we rarely question the starting price. We rarely ask what we're actually paying for future growth. Instead, we ask questions like, is this a good company? Does everyone trust it? Has it been around forever? Those questions feel responsible, but they don't protect you from overpaying. A great business can still be a bad deal, not because the company failed, but because the price left no room for time to work in your favor. Here's the thinking upgrade. Stop treating calm as safety. Start treating time as the real risk. Instead of asking whether something feels stable, ask two quieter questions. What am I paying for this? And how long am I willing to wait? Price decides how much time can help you. If you overpay, time becomes your enemy. If you buy reasonably, time becomes your ally. This isn't about finding exciting stocks, and it's not about avoiding strong companies. It's about separating the business from the price. A strong company doesn't automatically protect you. Only a fair price does. Think about it this way. If you buy something expensive, you're depending on the future being perfect. Everything has to go right. Growth has to continue. Expectations have to be met again and again. That's not safety. That's quiet pressure. But when you pay a reasonable price, you don't need perfection. You just need time. Time for the business to grow. Time for earnings to do their work. Time to absorb mistakes without wiping you out. That's what real safety looks like. Not comfort, not familiarity. Room to wait. This is true outside investing too. Overpaying for anything limits your freedom. a house that stretches you too far, a car that eats future options, a lifestyle that depends on everything staying perfect. Nothing explodes, nothing fails immediately, but time becomes tight, and when time is tight, stress follows. The same logic applies to money and markets. Price determines how forgiving time will be. Nothing feels safer than something that doesn't move, but time is always moving, and if you're not paying attention to what you paid at the start, time doesn't work for you. It works on you.